Hello and welcome to the Investing Master Series. My name is James Boyd. We welcome you on this Tuesday morning. Yesterday I took off outside teaching the class, so I'm just full of energy because it's my first day of the week. I'm so fortunate to be here with you here today. Looking forward to it. So we got with us Janelle, Elena, Andrew, JP, GT, BP, KB, and many others. Welcome to all. Just real quick, let's go ahead and hop right in. Now, this class, we talk about stocks and options on an intermediate basis. Of course, we talk about trends, different types of trends, most of them uptrends. But from time to time, we'll talk about strategies, maybe sideways or downward trends. So that's kind of, but predominantly we'll focus on upward trending examples. We'll also talk about stocks and options. And so as we go through that, just be aware of that. We'll do it more on an intermediate to advanced basis. If you have some questions that might be more basic, let us know. We'd love to help you. Now, just real quick, as we get started here today, remember you can go to my X page. I do post educational examples there. My handle is at James Boyd CS. Now, as we hop in, remember that when we talk about options carry a high level of risk and are not suitable for all investors. The information is provided for general informational purposes only. The examples that we'll do them in the paper money software application. And we do that to provide education of how do the strategies work, some good trades, bad trades, so we can learn from those. And also remember that investing involves risk, including loss of principal. So that's very important to understand. There's going to be losses, okay? And that is a part of investing. Not always going to win. Sometimes things go differently than what you plan. Now, also remember when we talk about short options, whether it's covered calls, let's say we talk about cash secured puts, things like that. Remember, those are obligations to sell the stock at the strike price or obligations to buy the stock at the strike price. And remember, that can happen prior to expiration. These are American-style options, not European. And so just need to understand that. Now, also, when we talk about examples, we will demonstrate analysis and trading functionality. Now, when we look at our examples here today, we'll take a quick look at where the markets are. I want to talk about kind of some prices first off, then indexes, just briefly. Talk about sectors, but we're going to really talk about some initial past trade examples right off the cuff. Want to talk about kind of management of those positions, good and bad. And then I want to talk about some new examples, okay? And so first off, let's pull this up just real quick. And you know, as I was kind of thinking yesterday, and I've been thinking about the last couple of weeks, I think probably 50% of someone's success comes down to being organized. I could go into why I say that, but a lot of times when people are doing something different every day, it's hard to get confidence and get consistency. So when we kind of take a look at the things that we do, I want you to think about it in terms of how do you organize your information to try to make decisions. So first off, we're just looking at this list right here. We're not going to look at the pricing. I just want to kind of see, or the chart, I should say. I just want to kind of see what's at the top. So what we actually see first off, we got gold, okay? And this matters because these futures, they're actually trading over the night, okay? Now, so that's gold. That's something we normally talk about when we talk about base materials or gold stocks. We actually see silver actually down here, 46.81, down slightly, down 0.5%. Now, the other thing that we need to actually kind of point out if we talk about energy stocks is you're going to see that energy or crude oil has fallen down a little bit. It wasn't at 66 last week, but it's actually dropped down to 62 here today. Now, again, that has an effect upon what happens with some oil stocks. So takeaway first off is precious metal still looks pretty precious. Gold actually did hit a brand new high here today. When we actually pull up the list, the index list, you're going to see that gold is right here. And you're going to see that on the 20, 55-day basis or days high, you're going to see that that is a brand new high. Now, we joked yesterday that gold cannot go higher because it's at the top of the chart. But that's like saying the chart can't go any lower and it's not at zero. So it can. It could. Now, if we take a look at the indexes, okay? Now, in the last couple of days, I think since last Monday, we've been really talking about the indexes, how they have been in a kind of more like a trend 4, trend 5, which is kind of more your flag type of situation. Anything different? Well, if we actually looked at the S&P, we'll pull up the let me see, NASDAQ, Dow Jones, S&P, and the Russell. Well, you got the Russell still in 5. You got the NASDAQ in 4. You got the Dow Jones in 4. And you actually got SPX literally still, it's actually gone back to 3. So remember, when we get, let's say, a trend 4, it's kind of like in that flag. It's yo-yoing, okay, up and down. It's probably in between the moving averages, not able to eclipse the prior high, okay? And if you actually see something like Russell, where you're in trend 5, it actually might be kind of struggling to kind of hold maybe closer to the prior high, and that's why it's actually in trend 5, okay? Now, when you look at the S&P being trend 3, that's probably a better example where it's pushing back up a little higher. So far, we probably say that the S&P 500 is probably doing a little bit stronger so far. Let's pull them up, see what they look like. S&P 500. Now, remember, the last couple of days, again, we're just objectively looking at the chart and kind of saying, do we have a green line on the moving average? And the answer is, as of right now, we do, okay? Now, that color of the moving average will change in a day if the price does, okay? Green or red, price goes up or down. And if you look at that, we're trying to really hold 62, 40, 66, 42. That's where the intraday low is, okay? Now, remember what I kind of said here is that we're in between the moving averages so far. Have not eclipsed that prior high, but when we actually go back to this, now remember, think about being organized, okay? Seeing, kind of being able to go through the information and see it. We can see on the S&P 500, it's day number 1 of the 10-period moving average. Okay, now that's how the bounces start, right? You got to start somewhere, okay? Price actually gets above the 10-period moving average, and that is day 1 so far for the S&P. So keep a note of that. Can that continue? Now, obviously, if we're saying the S&P 500, we're saying technology, we're saying financials, right? We're saying discretionaries, because the S&P 500 is not equally weighted. It's heavily weighted to those 3 sectors that I just mentioned. Now, when you look at, let's say, the NASDAQ, is it so different? NASDAQ's coming along, okay? Now, the NASDAQ might be trying to hammer here off the moving average line. When we say actually the NASDAQ, we could pull up the same chart, IXT for technology. It's going to look the same. The chart that we could look at to kind of say, is there any difference here? It's the semiconductors. The semis, I called up a friend of mine today and I said, hey, did you see this one stock? And he goes, no, I haven't seen it. And I thought, for crying out loud, what do you mean you haven't seen it? Okay, like obviously you didn't do your routine this morning. Okay, it costed you a lot. And the point I'm getting at is focus on your routine. Minimize distraction. That you don't do a routine typically because you're not organized. Okay, the organization comes from the list that you actually look at, whether it's on the left-hand side or on the Market Watch quote page, and it's actually how you systematically look at the charts. From there, you get investing ideas. And those investing potential trades might come from the Dow 30, the S&P 100, the NASDAQ 100, especially because they have liquidity, typically on stocks and options. The last list would really be the S&P 500. That's typically the playground we talk about because of liquidity. Now, if we take a look at this, want to go down to just real quick, well, what about the Russell? Okay, well, Russell's kind of still falling. Matter of fact, this actually looks like it's trying to break down from the bottom of the channel. We actually broke below it. Now we actually have a lower high sinking its teeth in, and it's trying to push down. The Russell 2000 becoming a little bit weaker here so far. Dow Jones itself, pull that up. It kind of looks more neutralish. If you did some covered call trades maybe a week and a half ago, some of those trades are probably still going. We will talk about those here today on some past trade examples, especially if one of some of these stocks are more neutral. And sometimes that's what happens. The trend consolidates. And sometimes people use covered calls as a way to try to bide the time and lower the average price on that stock. Now, sectors. If you look at, let's say, utilities, it's had a pretty good push still. When we actually talk about, let's say, the IXM financials, that has still been an area up near the resistance, pushing down a little bit here today, 1%. When you look at, let's say, the I want to keep an eye on IXI. You'll see why in just a moment. But when you look at IXI, the industrials, we'd have to say that's a group that's not really shying away from the resistance area, okay? Now, we've been kind of keeping an eye on the aerospace and defense, Lockheed Martin, LMT, RTX, Raytheon, NOC, Northrop Grumman, okay? Now, there's a couple of these that kind of, and by the way, we would also include in here GD, General Dynamics, okay? The aerospace and defense stocks, the aerospace and defense group has actually been something that's been quite strong. Keep an eye on that. Could that drag up the industrials as well? Now, obviously, when we say industrials, we would say Caterpillar, okay? And we would say things like Cummins, CMI, etc. Now, by the way, you might be thinking, well, how do you remember all these stocks? Well, when you watch them for years, they kind of become like children, okay? You just kind of remember their names. And these companies, larger caps, 10 years, Caterpillar's probably still going to be around, okay? So when you watch them on a daily basis, not weekly, daily, you kind of start to remember some of the patterns and some of the ticker symbols. Now, what I want to do is I want to kind of pull up just real quick couple stocks that on a Dow basis, okay? So on the left-hand side, let's work our way down and kind of see what's standing out. Now, when we categorize this list, we like to rank this in terms of percentage change. Stocks is at the top, tech, got healthcare. Now, healthcare has been something we're watching to kind of see if that can't get a reversal. From what I can remember, it's the biotechs that are actually being quite strong. And probably one of the stronger biotechs, I mean, if we're talking about healthcare, if we said consistently, what has been a stock that has bucked the trend of the healthcare? One of them, at least, is AbbVie. That did actually touch a brand new high here today. Now, if you go down to the Dow list, okay, and we said we're going to work our way down, lo and behold, yesterday we talked about weekly charts, and we said it's very sad for the people that don't look at the weekly charts because they say things like, no, I didn't see what was happening. Well, it says that you're not doing your routine, okay? The lack of not being aware is evidence of not being disciplined, okay? Now, if you take a look at this, okay, this is not really a surprise. Now, by the way, this is not the only stock. If we look at the weekly chart, yesterday we talked about that. We talked about these intermediate, which when I say that, we're talking about weeks to months. So when I say weeks, 2 to 3 weeks to 2 to 3 months, and what we kind of talked about yesterday is kind of saying, could we had the first sign of the momentum change. How? Well, it was just the 10-period moving average going green again. If this price gets above the 20-period moving average, in this case, the 20-week moving average, what color do you think that moving average could turn? Well, of course, it could probably turn green if the price stays above it. That's the idea, right? And we get that price to go up more and more. Potentially, you get a crossover and so on. The average person might say, I didn't see it coming. The whole point of having a shorter-term moving average is that you see it coming earlier than something like a 20, 30-day moving average that takes a little bit more time to show it. That's the point, okay? Now, other stocks that I want to kind of point out just real quick. IBM has actually been one that filled in the gap, and boy, did it fill in the gap. How long did it take to fill in the gap from 262 to 282? The answer is not long. If you're not paying attention to gaps, you probably feel like you were left in the dust. Gaps are very interesting, especially these gap downs. And when it actually got above the closing price of that red candle day, big reversal. The significance of those is you get shorts or people that trade bears to cover, at least the smart ones do, okay? Because if they don't, it could become more expensive to buy back, okay, as the price goes up higher and higher. Second, if bulls get in initially, they're trading a breakout, and if people are already in the position, they might add to the position. So you kind of really get a three-prong effect of the breakout, okay? Now, other things, if we want to kind of take a look at, let's go down through the list and kind of see what's standing out a little bit. Micron is, when we look at the NASDAQ 100, we actually see Micron right there, LRCX is right there, Palantir is right there. Just kind of taking a little peeky of what's kind of moving here. Now, if I take a little Palantir, that's the one we kind of made mention yesterday a little bit. Could this be setting up a little handle of the cup? And then if we actually go down a little bit and say, give me the S&P 100, and I will pull up the 500 in just a sec, but I want to see the 100 because we're being consistent to what we're going to do on a daily basis. When I look down on that list, something that's kind of standing out a little bit is the RTX, which we said aerospace and defense. There's IBM again here down the bottom left. There's GD, okay? There's AbbVie and so on. So really, in being organized, okay? Notice we actually have at the top futures. If you track prices, indexes, sectors, Dow Jones, you're going to see that we have the NASDAQ 100 there. We list them by percentage change, okay? And then what you're going to notice on that list, we also have trend 3 as well. Notice right there, there's a little gear. So we could just click on that gear and we could say customize, and we could put in those things that we want to have in that list. That's what I like to have in that list for simplicity. S&P 100, we could add one to the list. If you say, well, how do you add one? I'll say watch list. And what we'll do is we'll go to the watch list. We'll put S&P 500, okay? Wonder if I don't have the same as you? Well, we're going to go back to the gear just real quick. We're going to take the bid ask off. Bid and ask off. We'll remove that. We need percent change. We'll put that on. That's not too bad. And then just slap the trend on. Okay? Now, if I add that, there you go. So we just kind of made one up right there. Now, the harder thing about the bigger list of the S&P 500 is just lots of stocks, okay? And so now we see that list. Now, if I want to save this, how do you save it? Go set up at the very top right, set up. Now what we're going to do is going to go save workspace as. And what we're going to do is we're going to label this 2026, okay? Now, I'm going to tell you right now, I think it could be as much as 50% just not being organized. When you're not organized on your computer or things like that, your mind is not organized. You're not really focused. And you could have example after example after example, but if you're not really organized, okay, you just kind of miss opportunities, okay? Now, I'm going to click on that. So now when you go back to setup, you're now going to see in this case 2026. So when I pull up this platform, we should have the same setup over and over and over again, okay? Any questions there? Now, I want to kind of challenge you. I've done this, okay? Have I ever had times where maybe I felt a little sloppy and I didn't really feel prepared? Yes, I have. How have I been able to kind of unwind that and kind of focus more, just better, more efficiently? It's by doing the things that we're talking about, okay? Now, just real quick, let's go just real quick. So I challenge you to become more organized, okay? From the organization and feeling comfortable, number one, you get more comfortable. Number two, then you feel like you start to become more confident because you know what you're doing and why. And then actually from that, you probably are more apt to trade your plan. We always like to trade our plan first, but it does actually come from being somewhat organized first. Speaking of that, let's go to actually these paper trades. Let's kind of talk about one or two of these. One of them that I want to bring up just real quick that is kind of not doing what we want to have done, and I want to kind of show this, is I want to pull up, let's say, this city. It's a vertical, okay? So let's talk about now managing the positions, okay? And then we're talking about some new ones. So we have a 97.5 call, and we have a 97.5 put. Now, wait, are those both bullish positions? They sure are. Now, by the way, notice here that this is also organized. They're organized based upon what strategy that they are, okay? Now, why do you do that? I think of this like a file folder, okay? When I pull up verticals, I want to know what positions are in the account of verticals, okay? Now, I'll show you how you can put those, how you can put the categorization, but this is a part of being organized. The reason why I'm pointing this out is I think there's a lot of times investors, they're just kind of being sloppy and they're just not really feeling like they're kind of, the market's going up and up and up, but what's the real issue? Just not being organized, okay? And I'm going to show you how to organize, so just hold for a sec. We got a vertical here, and we actually, what type of trend do we have? We have trend 5. So what does this tell us? Well, on that trend 5, it tells us the price is dropping down below the 10-period moving average. When we look at the whole, it's telling us, hey, we've been down. The moving average has been red for 5 days, and the 20-period moving average, it's been down for 1 day. Now, some of you might be really confused on why does this show 1, why does this show 2? Well, because it's showing the trend of the option prices. We don't even care about that. What we care about is the trend of the stock price. Okay, so that's why when I open that, that's why you see the different numbers there. Now, in this example, what we're now going to kind of talk about is maybe manually exiting the position. So when we pull up Citi right here, what you're now going to notice is if we kind of said, well, let's talk about our timing, the red line on the moving average was right there. There's one. We also, for example, there's one, here's two, and what you're now going to see is yesterday, there's three. Now, I historically would say, well, I just don't know when to really exit. I'm going to push back on that. I don't think it's that people don't really know when to exit. People don't really want to sell when they see their sell signals. I think that's what it really is for 90% of the cases. So if I said uno, dos, tres, red moving average, crossover, and then more confirmation, we're seeing that here today. Now, that would be more what we call a confirmation exit. Now, the investor is saying, well, yeah, but now I got to make a decision. That is correct, okay? Now, what you're now going to notice is now this trade is a synthetic. Now, it is two bullish single options. And what you're now going to, because it has positive delta. And now what you're going to notice is the delta is almost 100. So if this stock goes down $1, it's like down almost $100. If the stock goes down $2, it's down like another $100. We'd be down 200. We go down $3 and it's literally down $300. And if we go down almost $4 like we are today, we're literally down $400. So the incremental movement, $1 down to $2 down, $2 down to $3 down, $3 down to $4 down, the incremental movement is delta. Okay? The incremental movement of the profit or loss is delta, the change in the stock price over the change in the option price. And what you're now going to notice is this position that was probably sitting up a heck of a lot higher today is now shrunk down to 129. Why? Because all the trades we actually do in class. Why didn't you sell earlier? Well, because we want to do the trade in the class, okay? Now, if you pull this up, we're going to sell the call. Why are you going to sell the call? Well, because we bought the call initially. What side of the trade benefited the most? Well, the side of the trade that benefited the most was the one that had positive theta. And that positive theta is the option that was sold. Okay? Now, Dragon Rider 108 says, why would you not want to sell them, sell when time to sell? Well, that's what we're talking about right now. Okay? Now, what I'm going to do is, now, if we looked at this and said, when was the time to sell? Well, if you said my criteria, the investor says, is step 3, it would be yesterday at the close. If we saw that, that could be an example of a sell if you use step 3. Now, if you said, well, I didn't see that, I had to take puppy to the vet or whatever, you're going to see that this morning it would have been the same. When was my class? Well, as of 23 minutes ago, it was right now. That's what we're talking about right now. I didn't have a class yesterday at the close. Okay, so I'm talking about it when we see it. Now, right click on that, create closing order, sell. And now what we're going to do is go confirm and send the order. Now, here's what I challenge you. In your paper money account, which is the purpose of practicing, I want you to see how in line you can be to selling when there are sell signals. Meaning, if the sell signals were, let's say, yesterday, what is the latency between when you saw the sell signals versus when you got out? If you said, I saw the sell signal 10 days ago, and then I got out 10 days later, how am I doing? We would say, well, the latency, it's like dial-up internet, okay? You're not kind of being on time. You had the signal, and it took 2 weeks to finally get out of the position. You're not really trading a system. You're now trading emotion, okay? So I want to challenge you to actually cut the length of time down to when you actually saw the signal in the paper money account to practice being more timely on entries and exits. Now, what I'm going to go ahead and do is we right-click on that, create closing order. Again, show that, confirm send. Now notice the commission when we actually go to sell, send. Now from this trade, there was about $125 left, but man, yesterday at the close there, if we had a class at the close yesterday, that could have been about another $400 higher than where it is. Now you're just saying it's 400, just 400 bucks, but 400 bucks is like another 1% on that account. Okay. Now I want to now, by the way, how would you know if you actually maybe are starting to kind of get a little sell signal? Oh, pretty simple. Well, remember the whole point of the 10 hole and the 20 hole moving average, if you see red, it's saying there could be red lines on the moving averages. Okay, that's number one. The color, okay. Now, number two is the number. And this is kind of telling us how long, number of days, I'll put D. And if we actually see it's been red for 1 day, we know this is fresh red, fresh turn down. This has been red for the last 1 day. So this is not like, well, where have you been for the last 3 weeks? It's just now done it. Now, when we talk about scripts, it's never guaranteed for accuracy of time. So that's why we want to have an understanding of what the script is. And then we can verify with whose eyes? Our own eyes. So if we pull up Bank of America with, let's say, 100 shares of stock, and we say, I want to see this myself. If we look at Bank of America, what you're now going to see is red lines on the moving average. Okay, red, one. And what you're now going to see is there was already a crossover already. So you could actually say there's 1 and 2. And the 20-period moving average is red today. Now, so first off, every time that someone gets maybe, let's say, the 3-step kind of selling method, that doesn't necessarily mean someone has to just sell the stock, especially if they say, hey, I want to actually kind of hold it a little bit, and it's kind of maybe in a range. So what are some strategies the investor might consider if they saw this? Maybe they could actually sell a cover call. Okay, number 2, they could maybe buy a put. Number 3 is they could do the combination of that. So we know where the stop is. The stop is down here. And we know if those lines are red on the moving averages, there could be selling pressure. Now, as a stock investor, you have 100 shares of stock. And that is wonderful if the stock is going to the upside. If the stock starts going to the downside, okay, all of a sudden, it's like, my heavens, now we're down 100. Now we're down, if it goes down another dollar, now we're down 200. And now it just becomes painful. Now, how many of you have ever seen that happen when the stock goes down $1, $2, $3, $4, $5, and you said, my goodness, okay, that kind of hurts, okay? And now what you're going to notice is the investor can alter the delta, okay, of the position. So if someone just stays long the stock, man, and that stock goes down, man, you're right, it can hurt. Man, you got to remember, this is only one position. If you had 10 positions that did this, that's why kind of people become, you could say they're emotional. I just think they kind of feel the pain, okay? Now, what the investor might do is say, hey, this is why some investors might consider callers. Callers are just saying, hey, could I sell? In this case, could I go back to Bank of America? Can I look and see if there's an ability? Now, in this example, I already have a cover call. I'm gonna kind of imagine that we decided to do a caller together. Now, we saw by being organized, we had a little issue with what we saw on the moving averages. What I'm going to do is I'm going to go back to the BAC and I'm going to look to sell a call option more than 20 days to expiration, maybe 20 to 50 days, looking at the monthly options. We're going to choose a strike that is above where the current stock price is, and probably preferably to actually be above where the trade price was. Why is that? Why? Because think about this, okay? Normally, if you bought it at 51.41, you probably don't want to sell it lower than that because you lose money. You're trying to sell higher than that, so there's some upside potential. So if we did that, it would be selling the 52.50. That's higher than what you bought it for. Okay, now we're going to take this. Now, a lot of times people, when stocks go down, people will say language like, well, it's all going down, but, I didn't want to pay for the puts. Well, why didn't you want to pay for them? Didn't you pay for it anyway on actually the account going down, the position going down? Well, when you put it like that, I can see your point. Well, let's kind of use that premium and then use some of the premium to buy the put on the other side. With what? Well, we're going to cap the upside on the stock shorter term, but then what we're going to do is use some of that premium to buy the put. Right-click on the call, sell, caller, synthetic. Now, what this is doing is it's saying, hey, look, we'll agree to sell the shares at $52.50. Give us the premium. And if we now take the $1.68, we now have a little budget here to come over to the other side and say, can we actually have a right to sell to the downside? Maybe create a floor, if you will. And we're going to say, look, we're going to buy that put at about 49. Now, the most interesting thing about a caller is it's changing the exposure. Instead of having $1, if the stock goes down $1, you lose $100 every time the stock goes down, or you're down $100, unrealized loss, you're changing how much you're losing. That's interesting, okay? Especially in bear markets. Now, what I'm going to do is there a credit or a debit? There's a credit on this, okay? Now, if we confirm and send, note the commission as well. Note that, and then what we're going to do is we're going to put that in the margin, and we're going to go to stocks. We're going to put it with the stock, okay? Now, I'm going to send the order, and what I'm now going to do is when I pull this up, that position, you're now going to see it's right there. We're trying to sell the 52.5 call. We got the 49 put. Notice when we have 100 shares of stock, 100 delta. The investor probably wants 100 delta when the stock is going up. When the stock is going down, they could overlay options on top and change how directional that position is, whether it actually has some time decay or exposure to, let's say, positive or negative volatility or vega. Now, what I'm going to do is I'm going to look and see if we can't just get this to fill. I'm going to change it to a market so we can get it to fill as soon as possible. And when you now look at this right here, we're going to look and see, can we get that to change? Now, there's BAC. We'll put that right in that section. There it is. Pull this back up. Now, remember what I said is by selling a call, buying the put, those are bearish options, single options. Now what you're going to notice is if you use that in combination of a stock position, the delta is not 100 anymore. The delta is 24. So what is that telling us? The stock goes down $1. How much is the position down? How much is the position down? What do we got? Well, if that stock drops $1, the position is not down 100 bucks. It's really down $24. Now, the biggest thing you need to learn is when markets or the stock price, the trend changes, how could you give back less? That is massive. So when people use things like cover calls or callers, what are they trying to do? Number one, define risk by having the put in place. Number two, they're trying to actually maybe lower the average price of, let's say, the stock. And really, number three is they're trying to change the sensitivity to the direction which is going against them in this moment in time. Okay? Now, the comment, and by the way, this question gets asked a million times. When we talk about taking off the collar, the real issue becomes when the stock goes to the upside. You are capped in the shorter term. So let me ask you a question. What would make you want to consider taking off the call? Well, you probably want to take the call off if the stock was going back up. Ding, ding, ding. Okay. Now, that could be like the stock breaking out of resistance. Now, if the stock is breaking out of resistance, what color do you think is the moving averages? Probably green. So could you just say, look, I'll take that collar off or cover call, if we maybe break out of resistance, or and by the way, if we broke out of resistance, the moving averages would be green. What happens if the moving averages are just still red? Okay, and you have a collar on. Well, if you're in a situation where you say, James, the last couple of days, Amazon's been down, 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 just day down. Well, the investor might say, well, when it's going down like that, what is the investor probably doing? Probably rolling the call. What about the long put? Probably holding on to it because it's not at the money, in the money. So the issue becomes if you had a stock position, you say, James, I had a cover call on NVIDIA, but then today it broke to the upside, getting above this area of resistance. The investor might say, I'm going to take the call off because I think it's a breakout and I don't want to cap the upside. Now, let's say the investor say, look, I don't want to do anything. I'm just going to let the probabilities play out. Could they be in the cover call and the caller and just let the probabilities play out and try to get a high percentage of the maximum gain? The answer? Sure. Sure. Okay, now speaking of that, let's go to NVIDIA for just a second, okay? Now, what I'm going to do in this case is, let's imagine, okay, now we've talked about kind of putting on collars all at once. It's like a vertical, okay, when you really look at the diagram. Now, what I'm going to do is I'm going to go back to, just real quick, let's kind of use NVIDIA. Now, remember, if we did a collar all at once, we're saying we're buying shares, selling the call, buying the put, okay? So obviously, if I went to the trade tab, said, how do I buy the shares? Okay, how do I buy the shares? Well, we're going to click on the ask price. So that's not too bad. Okay, click on it. Now, 100 shares. Now, what we're going to do is if we're going to do the call and the put at the same time, what you're now going to see is how do you do that? Well, we're going to go down to where it says advanced order, single order. And all this is saying is first buy the what? Buy the shares. Buy the shares. Okay, we'll come to Corning in just a sec. Okay, first trigger is SEQ. First trigger sequence. Okay, you're going to do a sequence. Sequence number one, buy the shares. Sequence number two, sell the call, buy the put. Now, what we're going to now do is on the call, okay, we're going to say, look, we're going to sell a call with a delta between 30 to 40. That is out of the money on the call side, or in other words, above the current stock price. Now, I'm going to tell you right now, there's people that I know of that they're scared to invest in the stock market because they just don't understand a whole lot, okay? And that's fine, okay? But, you know, honestly, when you kind of think about it, a caller strategy is kind of interesting because they can kind of learn, but and they're used to buying shares already. They're typically used to that. But this is where they kind of have a defined loss and a cap gain. And so it can only be so good to the upside. It can only be so bad to the downside. So it's kind of like we're bowling here, but we have bumper lanes, okay? Now, we're going to go ahead and buy the put to the downside. How do you do that? Click on the ask price of the put. Which put are we buying? The delta of 30 to 40. Now, in this example, we're just going to diagram it out. Now, I'm going to tell you right now, write it down on a sheet of paper. Get organized, okay? 186, let's just say we bought it at 186 flat. Okay, now you're seeing this 186.10, forget it. Let's just go 186. Let's say we can make up to the 200. What is the gain on that? Well, the difference there is 14 bucks. And what you're now going to notice is, well, do we get a credit or is there a debit? Well, it looks like we get maybe a little 15 cents differential. I'm just going to say it's pretty much nothing, okay? It's really a 15-cent debit, but it's not really going to add anything. So we get $14 to the upside. Now, let me make sure I'm clear on this. A $14 potential gain on a $186 stock. Are we okay to say that, what is that, 8% or something? 8%? 8%, whoop, $14 upside move on the stock, $186 stock. It's actually 7.5. So really, that's not a small move. That's 7.5%. Now, if the stock went to the downside and we went down to, let's say, 170, check me on that. My calculator's in the way. But if we did that, what you're now going to see is, there it is. What strike do we have? The 175. So what's the max loss to the downside? Well, from 186 to 175, the max loss is $9. So this really has a $14 potential upside and a $9 potential loss to the downside. Now, is it theoretical? Is it depends? The answer is no, because you have a right to sell at 175 from now into expiration. Now, let's say the stock is at 188 at expiration. What should the gain be? Well, you got $2 movement on the stock from 186 to 188. It's $2. And what you're going to see is it's times the delta. So if the delta was 30, it should be up about $60. What happens if the stock is down to 181? Well, that's a $5 down move, and times that by what the delta is on the position. If the delta was 30, $5 times 30 is negative 150. That's how you figure it out. Repeat this out loud. It's the stock move times the delta. Stock move times the delta. It's no different than saying the stock move times the number of shares. Stock move times the number of shares is stock terminology. We're doing options. So we're saying the stock move, up or down, times the delta. The delta is the conversion to gain or loss on the option prices. Okay? Now, if we take a look at this, we're now going to go ahead and put this position in. Now, if we take a look at this and said, can we show this example? We're going to do it. And I'm going to do it in the margin account, just for example. You're now going to notice when we sell a call, 65 cents. You buy a put, 65 cents. The goal of the investor is maybe not to make the $14. They might want to say, James, if I could get 65% of that, 80% of that, I would be tickled happy. Okay? So the investor does not have to try to get all of it. They might just say, look, I'm going to try to get some of it. Okay? Now, a part of your homework is, number one, get organized on your list and your market watch. Number two is, I want you to practice doing 2 to 3 callers. Now, the question we got to ask ourselves is here, is a caller a bullish position? Is it a bullish position? And I'll fix that. Is a caller a bullish position? The answer is it is. It's positive delta. Now, the question that came up is on, let's say, the example, okay, of GLD. And this is going to be a good question because we have the example in the paid money account. Now, what you're now going to notice is on GLD, which is Corning, it had red moving averages here. The investor that is long the position of stock is probably saying, look, it's been a nice trend to the upside. And what I want to do is I want to now kind of look and see the position. And let's show that here. We have shares of stock purchased at 76, and the mark where it is now is at 80.72. The shares have gone up $4. Okay, there it is. Now, if the stock goes up, the call becomes more expensive typically. Why? Well, because the stock goes up, it actually gets higher and higher or closer to the strike price and inflates the option price. The difference between what you sold it for and where it is now is actually the gain or loss. So we're down 124 on the call, but the gains are in the shares for an overall net gain of 279. Now, if we knew the future, which I don't, well, if we knew the future, we would have never done the covered call. We would have been up 403. But since we didn't know the future, we're up 279. Now, you know, a lot of you are like, man, I just want to get all of it. Well, how about we focus on just getting some of it first? Let's just start there, okay? Now, the question becomes is, well, maybe it's an example to buy the callback on GLW. Let's go back to what we said. We go forward here and we are going to look and see, does the stock break resistance or does the moving average colors change? It's not really a PhD topic, but let's just go for it anyway. So all of a sudden, if we take a look at this on 929, the color of the moving average change. This is the first sign that, hey, maybe the stock is starting to go back up. If the investor does not want to cap out the upside on the stock, yesterday would have been the first day to buy the callback if they want to take it off more aggressively. If they said, no, I do not get out until that secondary step, we don't have it yet. Okay. So you got to think about this. A bearish exit of a short call is really a bullish entry. Let me restate what I just said. A short call is a bearish single option trade. So if you're going to get out of a bearish trade, you're looking for a bullish entry. So if you said in this case, what you're now going to notice is, James, if we get step 2, I'm going to buy the call back if it does. Now, let's say that 20-period moving average is green right now. How do you buy the call back? Well, you go down to the single option that you have, right-click right on that line, right-click, create closing order, and then buy it back. Now, when you buy it back, it does lock in that loss of $124 plus the commission. So it is actually, think of it like this, it's theoretically adding $1.24 to that price, theoretically. Okay, so you got to remember that. So when you do covered calls or callers, you're either adding to the trade price theoretically or chipping away at that, okay? And that's how the investor trying to control some of these more volatile moves, okay? Now this is kind of the third part. If you've been practicing some covered calls or callers, I want you to practice the timing of the entries and the exits, okay? So organization number 1 we talked about here today. 2, we actually talked about practicing 2 or 3 callers. 3rd, I want you to practice the timing of these entries of covered calls and or callers, okay? So some good questions here today, okay? Good job. Now I'm out of my time here today. Want to kind of remind you that you can go to our YouTube channel. Right on YouTube, you actually can search up Trader Talk Schwab Coaching Webcast. When you actually find that page, what you can actually do is click on subscribe. That way you can see all of our content right on our page. Quick reminder that you can also follow us there for free. Now, I'm out of my time, but remember with what we discussed, it was done for example, illustrative purposes only. I gave us a homework assignment to go out and practice, to improve upon, okay? And don't say your dog ate your homework. You might not even have a dog. And also remember that Cameron May is coming up next. And I want to say thanks for all your comments and your questions and your participation. And Jack says hello back to you as well. That's why he barked. So with that said, have a great day. Take care. Bye-bye.